welcome. You're watching Market Fatafat on ET now with me, Snehi Shah, and with me is Vinny Motiwala. Vinny, wishing you a very good afternoon, but doesn't seem to be like a good afternoon for the markets, right?
Absolutely.
Because, temperatures are red hot, and that's the sentiment of the market as well as of now. Nifty trading currently at the lowest point of the day, 0.7% lower, and Vinny, expiry pressure also building in. Lots to watch out for, in fact, when it comes to market moves today.
Absolutely, that's what clearly Nifty trading at the day's lowest point. We saw it fall again, tried to make a bit of a recovery, then again that fall, 22,550 below that level now again is what the Nifty is trading at, down 0.7% in trade. Benchmark indices, both of them, Nifty as well as the Sensex, are trading in the red. Let's pull up what the mid cap is doing, right, as well as the small cap, how they are performing in trade. In tandem, seems like, the Nifty mid-cap is with the benchmark indices today, down almost 7/10 similarly for that. And small cap too is down almost 1%. So yes, small cap seeing a bit more of a pressure than the benchmark indices. Where is the green today? Yes, you have the Nifty Bank that's managing to hold on to greens. And yesterday also we had seen that these two banks, that's ICICI Bank and HDFC Bank, both of these were managing to hold on and pull up to the Nifty 50 or the Nifty Bank also in terms of an up move today. Also ICICI Bank managing to hold on to a percent of gains. HDFC Bank also holding on to a gain of almost 7/10 to 8/10%. And other than that, we have for the Nifty 50 overall, what is pulling the markets right now? When I'm looking at it, it's ICICI Bank, HDFC Bank, SBI, Axis Bank and Kotak Bank. So clearly the flavor of the day is the banks that what we're seeing at Sneh. But what's not exciting is when you see a heavyweight like Reliance, that's seeing a bit of a pressure today, down almost 1%. Infosys, ITC, TCS and M&M among the top losers that one could see, at least in terms of the top drags that are there for the Nifty 50. Other than that, let's talk some individual names. You have Interglobe Aviation that's holding on a 4% gain, Bata India, Sun TV, Samvardhana Motherson. We'll talk all about these stocks individually also, but right now they are some of the movers that we are seeing in trade. Other than that, let's pull up media. That's managing to hold on to decent gains. Nifty Media is holding on to gains of almost 0.8%. And in that, obviously, Sun TV, like I mentioned, that was buzzing. We have Saregama, that's also holding on to gains, as well as Nazara and Z, which is managing to hold on to gains of almost 1% as of now. Let's move on and talk about some of these individual movers that one is seeing in terms of overall the Nifty mid-cap as well. And in terms of the Nifty mid-cap, what is holding on to good gains today? We have Paytm, we have CG Power, as well as JSW Energy, Mankind Pharma after their numbers, which are managing to hold on to gains. But Tata Steel, that's the one we should talk about and put focus on as well, because they reported their numbers and today the stock seems to be a bit under pressure. But my colleague actually managed to speak to TV Narendran, CEO and MD at Tata Steel. Let's go across and listen into the conversation.
The worst is certainly behind us for the Netherlands business. Because we had a problem with the blast furnace last year. We had a relining which took longer than we had planned. The blast furnace is back in operation. So you will see quarter-on-quarter improvements. This quarter will be better than the previous quarter, so on and so forth. In the UK, you will see two tough quarters, which is Q1 and Q2. But in the end of Q1, in June, we plan to close the first blast furnace. And in September, we plan to close the second blast furnace. And after we do that, you will see UK also in the positive in the second half of the year. So this year is going to be a very crucial year. Turnaround in Netherlands. Last year was a loss. This year will be a profit, at least at an EBITDA level. And the UK second half, we hope to move from a loss-making facility to at least a balanced facility.
Okay, so you are indicating that in the mid of this financial year, break-even can be achieved in the Netherlands business?
No, Netherlands will be positive from this quarter itself. UK will be positive from Q3.
Okay, excellent. That is pretty heartening to hear. Sir, can you also tell us, you'll commence this assets in June in the UK business. The numbers will start reflecting it by when? And what kind of discussions are you having with the trade unions there?
Well, so the first phase is what we are already going through. We closed the coke ovens in March. More for operational reasons. We were anyway due to close it in June. We had to close it by March. There are two blast furnaces in the UK. The first one will close by June and the second one will close by September. That's a conversation going on with the unions. Obviously, unions are not very happy with it because there are job losses. But we've given them a very, very good offer so that the package or the separation is as generous as we can afford. It's much better than what's required from a statutory point of view, much better than what we've offered in the past. But that's for us to make sure that we do this transition as smoothly as possible. So by September, the heavy end of UK will be closed, and we will rely on imported slabs and coils for some time to take care of our customers, because we have customers in UK who will want to be supplied. And in the next 3 years, we will build the new electric arc furnace in the UK and go back to making steel in the UK like we've done in a much more efficient and effective way.
Right. Let's shift focus, Mr. Narendran, to your India business then. India operations continue to show resilience. Talk to us about how higher coking coal consumption is weighing on your spreads in the numbers, and also, is China factor still an issue as far as the pricing is concerned?
So coking coal prices have settled in the last 2 quarters. So last quarter, actually, the consumption went up by about $5 a ton. We had guided 10, so we managed to keep it at around 5. This quarter, we expect the consumption cost to drop by about $10 a ton compared to Q4. Our purchasing of coking coal on an average this quarter is about $30-$35 per ton lower than what it was in Q4. So you will see a little bit more of the coking coal benefit flowing through in the next 2-3 quarters in India. We are also working a lot on the different blends that we use, so that we use less and less of prime coking coal and use other coals which are not so expensive in our production. As far as China is concerned, the concern really is that China is exporting 10 million tons a month, which is the highest at a level at which we've seen Chinese exports in many, many years. It is not flowing so much into India yet, but it has a huge impact on prices in Southeast Asia particularly, and the rest of the world. Indian imports have started going up. We've been representing to the government that at some stage we will need to take some action, because the Indian steel industry, not just Tata Steel, everybody else is investing a lot of money in building steel capacities in India, and you don't want to derail private sector capex, because of unfairly priced imports.
Mr. Narendran, just a quick word on the demand on ground, the main sectors which you feed on to, real estate, infrastructure, autos, if you could tell us. And also, a sense is that right after elections, again, the focus on infra would restart. So do you see that demand momentum to pick up?
Yeah, I think demand has been strong in India, and that's why all of us in India have been able to sell most of the steel that we produce in India and have been less impacted by the international markets, the sentiment in the international market. So even for Tata Steel, exports is now less than 5% of what we produce. Traditionally, it's been 10% or maximum 15%. So the demand has been strong in India across sectors, driven certainly by the auto sector, which has had a great recovery, particularly if you look at commercial vehicles, which has been lagging 2019 numbers for quite a few years. So passenger, commercial vehicles, tractors have been strong. And in the last 6 months, we've seen the two-wheeler business also pick up. So auto is in a good place. Once in a while, they have a soft month or so, but otherwise they could. Construction has also been quite strong, though I expect the road construction to lag a little bit. I've been reading about it also, that it's more about peaking at maybe current levels and sustaining it for as long time as possible. But you see commercial structures are strong. GCCs are helping commercial retail space. Industrial structures are strong because there is investments in supply chains and factories, etc. So 6 months back, our concern was more the rural markets, but we are seeing rural markets picking up a little bit over the last 6 months. Urban markets have been strong, and auto and construction have been quite strong. So we expect that once the elections are over and we are all back to normal in terms of work, some of the activity will pick up again.
Right. And leave us with your thoughts on the way debt is panning out now, improved financials, and the outlook is looking good. Would that speed up your debt reduction plan as well going forward?
So one goal we have for this year is to bring the net debt to EBITDA, which is currently at 3.2, 3.3 level, to below 2.5. Okay, that means actions more on the EBITDA side than on the debt side. Debt will be flat this year as of now, simply because we are seeing the peaking of expenditure in India as we complete the Kalinganagar project. and we have a residue of some of the expenses that we incurred last year in the blast furnace relining in Europe, etc. And you will see start of the capex on some of the engineering work in the UK project. So I don't expect the debt to reduce significantly. It will be flattish this year, but I do expect the net debt to EBITDA to come to below 2.5, which was one of our stated goals.
Excellent, Mr. Narendran. Thank you very much for your time, sir. Great chatting.
Hi there, welcome back. You're still watching Market Fatafat on ET Now with me, Snehi, and with me is Vinny. Vinny, let's get the show started then. And this is a show where we're going to take you through all the buzzing stocks. And mind you, we have quite a lot of those today. All the stocks that are buzzing in trade on the back of their Q4 earnings or separate corporate announcements. But well, yes, we'll take you through all of those stocks in under a minute. So let's start then. Let's start talking about those stocks. And the first one on our radar today is Marksans Pharma. And this is on the back of its Q4 numbers. Then revenue has come in at 560 crore rupees versus 486 crores, which is up 15.2% on year-on-year basis. Net profit has come in at 78 crore rupees versus 83 crore this time last year, which is down 6% on a year-on-year basis. EBITDA has come in flat at 109.6 crore rupees, but EBITDA margin is the one that is spooking the stock at 19.6% versus 22.5%, which is down almost 300 bips on a year-on-year basis. The board has also recommended a final division of 0.6 rupees per share. Now, the US and North America business has held up pretty well, 26.5% growth over there. UK and Europe business is up 13%. Australia and New Zealand business growth is flat, whereas the rest of the world growth has dropped by 17% on a year-on-year basis. So that's also another factor that's ailing the stock today, and the stock is down 9.2% in today's trading session. So well, big cuts coming in on the back of Q4 numbers, Winning.
Absolutely, big cuts coming in there. After gaining for 2 consecutive trading sessions, now we're seeing the stock fall after a weak set of numbers reported by the company. Let's move on, talk about IndiaMart Intermesh, and why is this one in focus today. Now, they've acquired 10% stake in Identify, which provides solutions for KYC, background verifications and risk mitigation, digital onboarding as well as digital privacy. Cash consideration for this is at around 90 crore rupees, which is 4% of the net cash at the end of FY25. And when you look at the price to sales, the multiple is at around 7.6 times versus the IndiaMart's EV to sales multiple of around 11.4 times. When you're looking at it in terms of the revenue run rate also, that's been at around 117 crores for FY23, CAGR growth of 75% over the last 2-3 years. And in terms of overall, the target industries for them is going to be banking, e-commerce and Paytm. I beg your pardon, payments. We have banking, e-commerce and payments. While in terms of HR recruitment, insurance, capital markets and gaming is what one could be looking at. Today the stock has given up all those morning gains, nothing exciting happening there. But yes, it's not a bad news flow for IndiaMart. Keep an eye out on this one going forward.
Alright, well, let's keep it going with the stocks that are buzzing. Let's talk about Edelweiss Financial Services. This stock has been down and out ever since it opened up for trade this morning. RBI has taken supervisory action against 2 of its units, ECL as well as EARCL. So let's go across to my colleague Ankur, who's standing by with the entire explanation of why this RBI action has happened and what this could mean for the company going ahead. Ankur.
Yes, in one of the very rare instances, Reserve Bank of India has taken action on 2 of the group entities. Now, Reserve Bank of India has imposed business restrictions on ECL Finance as well as Asset Reconstruction Company of Edelweiss. And there are strong reasons for that. The first and foremost reason which has been stated by Reserve Bank of India is that there were material concerns essentially arising out of the conduct of the group companies, and they were entering into structured transactions so that there was evergreening of stressed assets of ECL Finance using the platform of EARCL and also few of the AIFs. So clearly Reserve Bank of India is saying that there was circumvention of the regulations, and hence Reserve Bank of India has reached to this conclusion. Now, how these circumvention of laws were done? One was incorrect valuation of security receipts of both ECL Finance as well as Asset Reconstruction Company. Apart from that, the incorrect detail of debt to lenders was presented so that the drawing power is increased. There were also allegations by Reserve Bank of India that non-compliance with loan-to-value norms was done by the company, and also incorrect reporting was done to Cleric platform, which is essential for lenders to report to Cleric platform on a day-to-day basis. Now, there are other observations also which has been given by Reserve Bank of India, which includes that FY22 supervisory, there was a report which was given by Reserve Bank of India, but it was not presented to board itself. So all these findings were there by Reserve Bank of India, and there were engagements by the regulator with the management, and after that such kind of action has been taken. Now, what is company saying regarding the same? The company is saying that there is no material impact of Reserve Bank of India action on EARCL. However, they have taken a cognizance of Reserve Bank of India's latest action, and they are working to mitigate the same. All in all, Reserve Bank of India has clearly stated by the communication which it had imparted that it is not the first step which it has taken or by imposing the business restrictions, but first warning was given. After that, there was engagement with the management as well as auditors as recent as last few months, and after that, as a final step, business restrictions were imposed on the companies.
Okay, Ankur, thank you so much for that update there. Surely keeping an eye out on that. But let's move on to the next stock that we're keeping an eye out on. That's Rephrased Engineering. They reported their numbers. When you look at it, a good set of performance that is coming in Q4 from the company. 12% growth in terms of revenues. Margins have remained flattish at 12%, while in terms of the profits of the company, a 44% growth. They've said a good growth in terms of operationally performance. When you look at it, operational performance, that's seen a growth of 8.5%. Order win obviously is working out well. Their control division has won large orders, especially from the US customers. So that is something that is supporting their growth. And other than that, obviously the non-automotive volume reduction was witnessed during the quarter. So that's what we're keeping an eye out on. But today, in terms of we've managed to speak to the management of the company. What is their outlook for FY25? What is the growth that one could expect from the company? Let's go across and listen
in terms of the outlook for the current year, I think we have talked about double digits without going into the specifics. It all depends upon how the Indian automotive industry grows. I think our assessment is that Indian automotive may grow 6-8% at the best, because we are seeing some slowdown in the passenger vehicle already with lots of stocks in the marketplace. So having that in mind, it's very difficult to say what would be the actual numbers. But all I can say is that we always said that on a consolidated basis, our business will grow 5 to 10% better than the Indian automotive growth. Overall, we certainly expect from the 11% or so margin for the overall year last year, we should at least cross 12+% in this year.
Well, all right, that's the word coming in from the management of Rephrased Engineering on the road ahead. But India's hospitality industry will continue to grow as demand remains robust, says Indian Hotels MD and CEO Puneet Chhatwal, who is also our guest editor for the day. Now, in an exclusive chat with ET Now, he shared the growth roadmap ahead for the industry. Let's go across and listen into what he had to say.
You know, there will be the usual short-term dips or headwinds that will come for reasons that we don't know today. Something will keep happening in the world, whether it's a geopolitical in nature or it's maybe a smaller form of a health scare. I would never want to take the word pandemic again in my mouth. So something will keep happening. But is it fundamentally a strong business? The answer is yes. Okay. Has it shown as a sector grit and resilience? The answer is yes. And my favorite quote is, it's like a plastic ball. You can push it underwater, but the moment you release it, comes back up. So, and that's how I would like to describe tourism sector. Is the wanderlust of people, whether on business or on leisure, is going to stay. And actually it's going to keep getting stronger and stronger and stronger as the society will benefit from more and more per capita income and more disposable income. The supply rate is going to be maybe high single digits, like 7-8%, and that is what has changed the dynamics. So firstly, not much supply got added in COVID period, and so there is a lag out there of 2-3 years while demand kept moving up. And it does take 3 years at a minimum to build a nice property in India with all the planning permission, construction, finishing, etc. Because a lot of this growth will come in new cities, which we call tier 2, tier 3, or destinations which are just spiritual in nature, which you cannot classify as a tier 2, tier 3 city. So I think all in all, that taking that old way of saying that so many rooms are coming, no.
Not the right thing.
Yeah. So many rooms are coming. How many are in metros and how many are in non-metros? I think that's the key.
Well, all right, that's the word coming in from our guest editor today, Puneet Chhatwal, on the road ahead for hospitality and tourism in India. But viewers, with that, we'll slip into a very short break on this edition of Market Fatafat. More buzzing stocks on the other side when we return.